Our next session will help you with just that. Our next talk is titled The Ultimate Compounding Machine, Your Mind, How to Train It. To tell us what this session is about and introduce us to our next speaker, I would like to welcome Mr. Paresh Thakker. Paresh is managing partner at ValueQuest Capital LLP, a SEBI-registered investment advisor which advises its onshore and offshore clients on their public market investments in India. ValueQuest follows a private equity style to listed equities, focusing on high-quality businesses with a buy and hold approach. Paresh has over 25 years of experience in the field of investment management, including listed equities, minority private investments, buyout investments, and fund investments. He has been involved in numerous investments across geographies and has deployed over USD 750 million. Prior to co-founding ValueQuest Capital, Paresh was head of Religare Global Asset Management. He's also qualified CFA, CA, cost accountant, and company secretary. So Paresh, over to you.
Thank you, Jitendra. Thanks for your kind words and your generous introduction. I also wanted to thank the CFA Society, Navneet, and you for providing me this opportunity to moderate the session. Thank you. Yen is very special. Yen has been a friend and a well-wisher for many years. So it is a huge delight to have Yen join us for this webinar. Yen is the managing partner at Aravt Global. Aravt Global is a long-short equity fund. And Yen has a couple of slides where he will tell you more about Aravt Global. Most of us dream about, the market sell-off, kind of a big market sell-off where we can just go and buy aggressively all the great businesses which we've been admiring for years at mouth-watering valuations. Our pipe dream came true a few months back. But when the dream came true, only few of us could actually decisively act. Most of us missed the bus. Why did this happen? Why did that only few of them, were ready to basically act? And why was there self-doubt for some of us and we missed the bus? Many of us have such similar questions. And fortunately, we have Yen. Yen has an exemplary track record of delivering alpha over years. And Yen has consistently been able to benefit from market opportunities whenever they have presented, like in March. Yen is a big believer in the importance of training the mind. In Yen's word, investing is no different than professional sports. Every investor needs to train for 50% of the time like professional sports people do. And Yen is going to share his thoughts and his learnings about the best techniques to train our mind to develop that conviction and be a better investor with us today. I would like to welcome you, Yen, and I would like the audience to join me in welcoming Yen. Yen, over to you.
Thank you so much, Paresh. I just want to do a quick check. You can all hear me clearly? Fantastic. Well, thank you very much, Paresh and Jitendra and the CFA India Society for having me. I'm speaking to you all from New York. Things are still a little crazy in New York, but we can't wait to be in person with you in India in the near future. I hope everyone is safe and well. I'd like to thank everyone for this opportunity to share some thoughts. We're going to focus today on really training your mind and being prepared for opportunity and being able to discern between risk and opportunity. We have two sets of presentation materials for you, and we would encourage you all also to submit questions throughout this session. Paresh will be gathering them, and we'll actually take some of those questions about halfway through this presentation, and again at the end in the Q&A. I would love to make this a bit more of a dialogue to make sure it's of value to you. Just to give you a heads up, we've got about 60 slides prepared for you to walk you through some key learnings. And there is a 59-page case study that I want to show you exactly how we train. But again, I would love to make this a conversation. So with that, I will dive straight into parts of the presentation, and hopefully let's make sure everyone can see this. I'd just like to check that you can see the slides. Are the slides up? Paresh, can you see the slides?
Yeah, yes.
Perfect. Now you can. Okay, now you can. Okay, wonderful. All right. Before we begin, I'd just like to, ask you to look at this disclaimer and those watching on recording later before you review the rest of the slides. So as a quick introduction, who am I? First of all, you're hearing Australian. So I'm actually originally from Malaysia, from Kuala Lumpur. I was born there before emigrating to Australia, but I'm originally Chinese. So you're hearing Aussie. I'm actually Malaysian, but I'm 100% Chinese. So a little bit of cognitive dissonance, but hopefully that explains a little bit. The next part here is my career. So I'm a Mozzie, I call it, a Malaysian Aussie. My training is I did a commerce degree and law degree at the University of Melbourne before doing my MBA at Harvard Business School. From a career perspective, I was a consultant at Bain & Company in their San Francisco, Singapore, Sydney, and Beijing offices before business school. And then I worked at Ziff Brothers Investments for 13 years. That was the equity market neutral strategy of the Ziff family from Ziff Davis Publishing before founding Aravt Global 7 years ago. So Aravt Global, we were formed in 2013. We launched the fund on February of 2014. My team is myself plus 3 analysts plus 3 operations staff. We run about $500 million. And the strategy, as Paresh touched on before, is equity long short. And we just launched our long only strategy this past month. So our journey, there is many people who are going to be joining us on this journey. These are some of the cast of characters that have taught me many things about life and investing. And the session before this I loved, which was really, again, that the art of investing is really the art of living and learning more broadly. I believe investing is competitive learning. And these are some of the cast of characters who have taught me along the way. So before we get into all of the areas of training the mind, I thought it would be important for you to understand what we do and why we did it. And I'll start with the premise that the world does not need another investment firm. In North America alone, there are 3,800 hedge funds and 9,000 long-only funds. If you're going to come into this professional world, what is your contribution? And ours was what we call framework investing. Framework investing is taking the patterns of history and discerning them, looking for high performance strategies, and then applying them to current market contexts. This is a data set. I did this 3 times over the past 15 years. And to try to understand, actually, first of all, who were the companies that generated extraordinary right and left tail performance, and then deeply study those patterns. So these are long-term, repeatable, scalable strategies. And because there's lots and lots and lots of ways to make money in the short term, there are very few ways to make it in the long term. So our findings, and these are US listed entities only, above 2 billion equivalent market capitalization. On the left side here is rolling 10-year, 20% stock compounders. So that's about a 6 times return on cash over that decade. There were 90 unique companies that did it between 1990 to 2016, 90 unique businesses or 3% per 10-year cohort. On the right side here is 5-year rolling 20% stock performance. That's about 2.5 times cash on cash return. There were 645 unique companies or 14% per cohort that could do it. So what happened was, and we did this again 3 times over this past almost 15 years, we grabbed this data set and we looked at every company. I wanted to know what these outliers did. This is the right tail. We did it for the left tail as well. And what we found is there were 3 repeatable strategies. The first is compounders at large. We do a subgenre I'll describe in a minute. The second is there was a commodity framework, which effectively was China and India hitting the global supply chain, where there was a delayed supply response. And then finally was what we call quality transitions, which is a M&A based framework which consolidates and improves the quality of an industry and or company. So what do we do? And we're not going to spend much time. This is a very different speech in that I'm not going to really spend that much time on strategy or current market conditions. What I'm going to focus primarily on is the eternal controllable variable of knowledge. We're going to teach you how to think. I'm going to teach you how to train. And that is far more important than the waste of short-term data points. We're going to teach you deep patterns, but just to quickly shape what we do so that you understand how we landed. So of those 3 strategies, we focus only really on one. We call them horses. And these are monopolies and oligopolies that compound earnings power at 2 to 3 times broad market averages and trade at what we believe to be reasonable prices. It's a very, very simple thesis, but it has taken a tremendous amount of effort to narrow this down. We only focus on economic monopolies and functional oligopolies because we do not like competition. Competition makes predictive ability much weaker when you study history. That one variable, in my view, is the key determinant for predictive ability. Compounding earnings power at 2 to 3 times broad market averages is what we call the alpha wedge. The S&P 500 has compounded earnings power at 60 years at 6.9%. Price return on the S&P 500 for 60 years has been 7.1%, 10.1% with dividends reinvested. We hold our earnings power in the 20s to sometimes into the 30s. And when we maintain that level of difference in the appreciation of our earnings power, that is what over time we believe drives the difference in our stock performance as the function or the driver of multiple in its contribution to total return dissipates with time. Said another way, multiple is very, very important in the short term. It's not at all important in the long term. And then trading at reasonable prices is obviously getting very good basis, being very patient. You get great basis, and over time, the earnings power is the only thing that drives your return. So what is at stake today? What are we trying to achieve? The focus of today is how to learn fast. So there's a decision that I want to equip you all to make, and it is 100% in your control. You can learn, you can work out, and you can decide how fast you will learn. And that will determine how successful you can be. This is a choice. And the quality of your life is what is at stake. And it sits literally on the other side of focused effort and tremendous struggle. So 2 spoiler alerts. The first is there's no shortcut to this. There's no easy way to success. However, there are very long ways. The second is I don't believe there is anything that defines a perfect way to invest. Every single person on this screen is an extremely successful investor, and their philosophies are vastly different. But again, there may not be one way, but there are ways to make it a lot harder. If you're going to enter the arena of investing, you have to consider that investing is a full contact blood sport. And you have to train like a professional athlete to survive, yet alone thrive in it. There will be times when it's easy to make money. And those moments is when risk is creeping up on you and you have no idea. But to sustain this for very, very long times, you need to be able to train and train for a long, long time and do it with excellence. The barriers to entry in this industry are very low. The barriers to excellence are extremely high. Every single sport I know, people train extraordinarily hard. I just don't know of any activity that's done at an elite level that doesn't involve rigorous and exhausting training on a consistent and constant basis. And in fact, the greats train even harder at their peak. I find it extraordinary that investing is a sport that people think they're training by just constantly putting capital at risk. There's an absurdity to that in my view. So the first and most important thing is I want to change your relationship to pain. This is really, really important because if you don't neurologically rewire yourself, it's going to be a very difficult life for you. And I believe this applies to everything, not just investing. The first is you need to fully embrace the struggle as your partner on the journey to excellence. Billie Jean King was a very famous female tennis player. And one of the quotes that she is famous for is pressure is a privilege. It only comes to those who earn it. The easy decisions. This is a business that is literally trillions at stake. No one hands over something that valuable if it's that easy. And if you've earned the privilege to be in the arena and to make key decisions, you must be able to handle this pressure. Pressure is a privilege and it only comes to those who earn it. And for those of you who are leaders in this forum today, as you ascend to higher and higher positions, the decisions that you are required to make only get harder because only the hard decisions are handed to leaders. The easy ones should be handled by your people. And if they're not, you don't have the right people and you're not structured in the right way. So a key lesson here is the difference between struggle and suffering. This is a spiritual definition, and I firmly believe it changes your relationship. The first part is struggle is pain with meaning. You understand your why. You can persevere. Suffering is pain without meaning. If you come into this business just to make money, you will not be able to persevere for 10, 20, 30, 40 years with the pain that comes with this journey. For those of you who master this, we don't feel the pain. We feel it in a very different way. We register it and it's just an acceptable part of the ride. The difference is context. It is your why. And once you learn this, if you're struggling, it's the neurological precursor to knowledge. Your brain is literally rewiring. That is one of the enablers of the aha moment, is when your brain is struggling with a concept that you don't already have mastered. Embrace and understand that struggle, because it literally is the neurological precursor to insight. Okay. So what makes a great investor? There are three elements. The first is a great mind or taste. That's IQ, but a trained IQ. And that is the focus of today's conversation. The second is a great temperament. That is EQ, or emotional quotient. I would argue that is more than half the game. It's understanding yourself, your emotions, and being able to handle the tremendous vicissitudes and tension that comes with capital markets. And then the third is a huge work ethic. The three combined are necessary but not sufficient conditions for success in our business. I'd like to introduce you to a concept I call the 10X. The 10X is if you double your ability on a key node of your capability, it will 10 times your long-term net present value. Let me pause here. This 10X point will change throughout your career. For the younger analysts on this conversation today, it may be as simple as accounting and basic finance and modeling. As you get to more advanced stages of your career, it may be much more on structural risk management, and it may be more on behavioral finance and idea generation. It changes over time, but you must be cognizant with your own training plan. Where is your 10X? And it will shift. And this is where you need to pound away to increase your capability. So business definition. First of all, in investing, we are in the business of risk, right? One way to generate return on one end of the spectrum is no risk. The other end of the spectrum is extreme risk. Our job is actually balancing your peace of mind and your clients and performance. The and is one of the keys in our business model. But just again, understand we are absolutely in the business of risk, but finding that equilibrium point between peace of mind and performance is one of the gifts of matching the external game of investing with the internal spiritual game of who you are. We are also in the business of thinking. You have to think for yourself, and it's not just independent thinking. Don't expect to be taught. You have to discover for yourself. The concept is called Aya. EA is the way you spell it. Aya is the way you pronounce it. It means personal sovereignty. It means you must be accountable for the speed and what you learn. You cannot cede this to anyone in your life, because the stakes are literally the quality of your life. The reason I have a picture here of Walt Disney and Mickey is I believe investing is competitive learning. And if you love to learn, and if you are competitive, it is literally Disneyland for adults. I think it's the most fun profession in the world for those who are curious. It's a profession that can last a lifetime. If you are prepared, if you know how to train, and if you know how to condition your emotions and align them with what you do. For those of you who are perfectionists, or for those of you who think that they can handle all the pain of investing without some mental model to navigate it, it can be excruciating. And this is something I hope to share with you to work out as early as you can in your lives. So I want to share one mantra with you. And this is just a simple mantra I use to navigate my journey, which is, and there are many I would add, but this one is for the purposes of just learning. I want you to decode, I want you to simplify, and then execute, and then refine. And it goes back to the top. You're trying to decode patterns. You're trying to simplify them so that you can execute them under market conditions. And then you want to refine as you get feedback loops on how to adapt them to market situations and within your own emotional makeup. It's this constant loop of all 4 steps that lets you refine your game. So to start with my journey, I'm going to share 2 very embarrassing moments with you. And there's a reason for this. And this was when I was at Ziff Brothers Investments. And the question was, how do you lose money on a stock that goes up 100% in a year that we were long? Now, Ziff Brothers Investments is a private family entity. I apologize. I've had to cover up the name of the stock. I can't talk about any of the holdings they had. But this, as you can see, from 2005 to end of 2007, the stock went up 7 times. I covered 3 groups at Ziff Brothers, technology, media, telecom, energy, and agriculture. And we were long this stock, not even once, but 3 times that year. And it was up 100%. This was a enormous fund, multiple billions of dollars under management. Why did we do that? In 2005, we were obsessed with what people call edge, variant perception. We missed the forest from the trees. This was a major technological innovation, a complete shift in the way that this company was going to market and the market at large. We were obsessed with Taiwanese supply chain data, with all of the different data we were getting from China, channel checks, completely irrelevant. This stock went up 7 times in this 3-year period. This was so embarrassing for me professionally. It got to a point internally where I literally told the managing partner and the chairman, if we mention this stock in my presence again, I need to leave this firm. I had to hand this stock over to another team. It had become such a great distraction. The reason I raise this, and Gandalf is, I want to introduce you to Gandalf. So Gandalf from The Lord of the Rings is looking here with a demon, and he's on a bridge, a stone bridge, and he holds his staff and he shatters that so that the demon can't come and consume his friends. And this is the journey of mistakes, right? And the Gandalf moment, I'll introduce you to that in a minute. But Charlie Munger, who I know you all admire, he says, mistake evaluation is one of the most important parts of your game. If you forget your mistakes, it's an enormous error because you are missing a chance to improve your cognition. Josh Waitzkin is a friend of mine who wrote a wonderful book, which I would strongly recommend, called The Art of Learning. The Art of Learning talks tremendously about how you strive for excellence. And his view is, in the long run, painful losses may prove more valuable than your wins. I 100% agree. I'm going to share with you 2 of my absolutely enormous mistakes and how they've unleashed my performance. So now let's get back to Gandalf. Gandalf is, in my view, it's the difference between emotional and intellectual learning. Intellectual learning is very skin deep. It doesn't go deep enough. The Gandalf moment for me is emotional learning, where you feel the mistakes deeply, but not so deep that it hinders your development. So I had a Gandalf moment with my team after this. I pulled them aside. I grabbed my staff and I said, this shall never happen to me and my team again, ever. Thou shalt not pass, never again. Never, ever, ever again shall this happen to me. And this happened, literally, in the next 2 years. This is another company in the technology space where we generated enormous return on capital on a very large size of capital. It was our largest position by a country mile, and we over multiples and multiples and multiples of our capital in the following 2 years. The point was here, this is when we started looking for discernible patterns that we had high confidence in and could withstand volatility and act with supreme conviction. Before we were acting more on instincts, we were already very successful. I was at Ziff Brothers from 2001 to 2013. In that prior period, 5-year period, we had already been tremendously successful, but we hadn't discerned a lot of those instincts, a lot of those patterns, and made them explicit. And that's another very, very important thematic I want to share with you today. There's an enormous difference in investing in a lifetime between what you think and what you know, between the implicit and the explicit. When you make the explicit and bullets start flying, you know what to do. It becomes opportunity. When it's implicit, there's lots of demons, and it's very, very challenging emotionally. And so this was one of the most important switch points in my career, where we took implicit patterns and we made them very explicit. And this was the ultimate test of courage for us to be able to put those to work. And I'm going to show you how we did it. So I prepared a separate video, which I would encourage the younger analysts on this in this forum to look. It's in my YouTube channel here under Yen Liao, Evolution of a Public Market Investor. It's about 17 minutes long. I did this for a class that I taught at NYU a few weeks back, and it will walk you through the most important steps between the analyst to a moneymaker to becoming a portfolio manager. I'm not going to go through all of it, but the main points are there are some very, very specific areas that you need to train your capability to transition your careers to various stages, and you want to do it as fast as you can. So part of this is just being explicit on what those goals are and what the different steps are. And what I'm going to touch on in a minute is actually, again, how to train aggressively to find the first stage, which I didn't touch on that video, which is idea generation. So the path, and I would recommend a tremendous book by Gautam Baid that wrote The Joys of Compounding. It's a wonderful book. And compound math is the most powerful force in the universe. I'm sure plenty of people are going to talk to you about compounding. By the way, again, just for the purposes of this talk, this is a very different talk in that I'm really not going to focus that much on strategy. I'm not going to focus that much on stocks. I'm going to focus on your mind. And compounding is the most potent force you have in the universe, and it applies to everything. It applies to capital. It applies to your ability. It applies to your context, your mental models, your experiences, your relationships. Everything works on this exponential curve. The only thing I want you to take away from it, there's two parts of it that matters. One is the compound ratio, the learning curve, the I, and the second is the N, which is the length of it. And people chronically underestimate the N. Duration matters more, actually, than the I does when you start talking in the second, third, fourth, fifth decade of your life. So you need to control both. The learning steepness is up to you, and that will determine your financial outcomes as well. But if you can do it for long enough, and we'll get to Warren Buffett at the back end of this speech, if you can do it for long enough, the returns become extraordinary. The focus I want to actually really center on is the right side here, which is the step function mastery chart. And this is the x-axis here is time, the y-axis here is ability. And the reason why they're step functions is because we call them controlled and uncontrolled leaps in ability. The uncontrolled leaps are the aha moments. These are where all of your neurological inputs come together, all of a sudden rewire, and you can see the world in a vastly different way than you saw it before. You are literally a different person. The controlled leaps is when you can concentrate your efforts to lift your capability. And that's the focus for today. How do you create controlled leaps? We do it through the case study methodology. Some of you may go to business school. Some of you may attend things like we are today, where you're consolidating knowledge into very constrained timeframes, pushing a question, pushing an issue hard, and that lifts your ability to see. And this is a permanent step. And so the point that I want to drive home to you today is the aha moments are hard to control. You need to create enough white space. You need to distill enough knowledge. You need to add enough data points. You need to create a mental framework. Those in schools and academic environments help you do some of that. But I want you to take command of your controlled leaps. How do you lift your capability and do so on a consistent fashion? That's what I'm going to show you today. So the goal here is to learn in dog years, to accelerate your pattern recognition and judgment as fast as we can. The laws of compounding say, get this right and get it right early and then unleash time. So we talked about the mantra before, the 4 steps of decode, simplify, execute, and refine. This is decode and simplify. This is just working out those first 2 steps. And what we're really trying to do here is create almost a flight simulator to accelerate your experience base, your experience curve. The alternative here is that you only learn at the speed of your true real life experience, which is really slow because you need to, it's a function of repetitions, and then the length of the feedback loops and data sets after the fact. Those can be tremendously slow. So could you imagine a counterfactual here of where you would have a fighter pilot trying to work out only when the bullets are flying? Just to give you a sense of it, a joint strike fighter, the F-35, is an $80 million plane. Could you imagine the absurdity of the US government saying, you know what, and I've got friends who are fighter pilots, just go work it out when you're in battle. Well, that is what many people are doing in financial markets. There's a complete absurdity with it, with far more capital at risk than a joint strike fighter. So how does it start? I want to introduce you to Tim Ferriss. Deconstruction is how this starts. It starts by knowing your goal and then how to construct the skills and then training those skills. Tim wrote a book called The 4-Hour Body and the 4-Hour Work Week. He's a wonderful podcast. If you want to study deconstruction consistently, he is the absolute master. Deliberate practice is the next component of this. You have to train and train a lot. There's a 3-step process. The first is it's got to start with a cogent mental model of what even perfect execution is. This applies to skills and a knowledge base. By the way, nothing specific to investing here. It's a universal law. The cogent model of perfect execution, because you need to know what good even looks and feels like. I call it the Tai Chi swing. I'm not a golfer. In fact, I'm a horrific golfer. But doing things very, very, very slowly and breaking it down to its technical components lets you see what you need to know and then refine. Speed covers up a lot of ills. The second step here is you've got to practice a lot. And that means pushing it to the edge, not doing what you're already capable of doing. It's hard, but it's fun. And it's built on one key paradox of struggle. If you aren't at the edge of your ability, it's not making you smarter. It's not making you stronger. And there is an optimal gap, and it's quite at the point of resistance in what you're trying to do in your training. You're trying to find a way, again, there's a sweet spot where learning takes off, where it's just outside of your ability of what you know and what you're striving to, and that's called the flow state. The next is a feedback loop. In order to learn, you need to know that you're directionally moving in the right place. And so it's not about literally going out there and just hitting 1,000 golf balls every day blindly. It's about hitting 100 perfectly. And then it's developing an evaluative process to refine it. So it's not about speed. It's about being much more purposeful in how you approach your training. This is another one of my heroes. His name is John Wooden. I would strongly recommend his books. They're absolutely outstanding. Wooden on Leadership is the one I would start with. I've literally read every one of his books. He was the most successful NCAA basketball coach in US college history. He coached the team at UCLA, and that's him with Kareem Abdul-Jabbar on the left side there. He is the master of process over outcome and liberated my mind and my emotions and my training in many, many ways. Very, very inspiring in the way that he trained his teams to greatness consistently and just had processes that well outlived him. So mastering investing means you have to learn in dog years. If you don't train and refine your learning style, you can't see great investments if they were literally in front of you. This is what you must prepare, right? Luck comes to those who are prepared. When you have events like happened in March or in December of 2018, they don't come often. You don't need them to come often, but you must be prepared to act and then have the courage to act when it comes. You can't make it up then. Some accelerated learning techniques. This is from another class I taught to Columbia Business School at the start of this COVID crisis. I've put 3 decades of accelerated learning techniques into a single video. And the YouTube video here is Yen Liao Mastery Learning How to Learn. I would encourage you to look at that. It's going to give you tools to acquire accelerated learning techniques, again, for any discipline, not necessarily investing. All right. This is the crux of what we want to really get into. So frameworks and case studies is the crux of what we do. It's the singularly most important part of my R&D and something that I've spent a tremendous amount of time. I want to separate out 2 parts, first of all. I'm going to focus mainly on the mental training. This equally applies to skills training. If you want to build up skills, you have to do the exact same process. We spent an entire year on primary research, a whole year, everything from how emails are written how you ask questions, debrief, where you sit in an interview, or at a dinner. Every single step of our primary research process, we spent a whole year diagnosing. We spent literally half of every interview that was done over a phone call for a whole year had someone else evaluating it. And that's what we do to refine our game. The focus of today is much more on the mental game of frameworks. So this is by far the most important thing that we've done over the past 10 years. It's a critical part of refining judgment on literally anything. Good judgment is always a function of mental models and frameworks. If you find anybody who has good judgment, what you have to work out is what is their mental model. I guarantee you it is there. And the reason it's there is because it requires iteration. So mental models helps you see opportunity. It's required because great judgment is an iterative process to refining a framework. And you need to develop and refine your frameworks as soon as you can. I firmly believe once you work them out, that 80% of almost all decisions are generic. And if you create the right mental models, it doesn't take up a lot of energy. In fact, you need to focus your judgment only on the critical areas. And this also massively reduces your error rate. So frameworks helps you with pattern recognition. And the real question is, how do you systematically break down this vast universe of investment opportunities to a finite set of ideas that you have a chance of creating sustainably superior returns? There are less than a few hundred companies on earth that qualify for what we do, and that's all we focus on. The vast majority of securities I don't have a view on and will never care. I can't focus on them because there's only a few that once price dislocates, I must be ready for it. And my team knows what they are and they are ready. So the focus here for us is how do you maximize your return on time? Time is the scarcest commodity we as investors have. It's not capital. Capital we can create. So how do you learn fast? Judgment and insight is not a function of time. It's actually a function of repetition. But repetition, again, within the appropriate model. So it's a function of exposures to decision sets and decision points to help condition your pattern recognition and then refine judgment. It's actually a controllable variable. So pattern recognition is exposure to statistically significant data sets to form causal relationships. You need to see enough to be able to work this out. And then judgment is exposure to the decision points and feedback loops that lets you make those decisions, refine a model, and then have evaluative sets that come back to tell you, are you making sound decisions or not? So I asked this guy, his name is Eddie Lampert. I asked him in 2006 and 2007. Eddie compounded capital at 30% for 20 years. This is the absolute super leagues of investing. And I asked Eddie, how did you do this so early in your career? He started doing this in his mid-20s. He told me he asked these three guys. I think you all know who's the top left. He actually got some time with Warren Buffett, told him the same thing. He learned this from studying the best investments in history rigorously. Warren is famous for reading a tremendous amount each day. 500 to 600 pages is what he defines between books and annual reports. Robert Rubin was Eddie's boss at Goldman Sachs, former Secretary Treasury of the United States. And on the right here is Richard Rainwater, who ran the Bass family fortune. And Eddie discovered from these guys the essence of the right tail. And he told me he studied them through a case study methodology. I never actually saw what he did. And he told me to go do this. This is the first one. This is Autozone. Autozone is an aftermarket auto parts supplier in the United States. And one of the most successful investments in the United States over this time period. And Eddie was huge in his portfolio in this one company. So this is a stock. This was my very first case study in 2006 and 2007. We have done this one at least 3, 4, 5 times now. And I'm going to share with you O'Reilly in a minute, which is one of their competitors. So we started studying these. I'm looking for patterns that are persistent, that transcend industry structure and time. We started looking through all of the different compounders. or the right tail and trying to work out what is the same between all of these different companies. It's different geographies, different times, different industries. But we're a long short fund. And also one of the more important parts is what you avoid or what you short. So we started studying the left tail as well. Same methodology. What is it that took these formerly great businesses and crushed them? What could we learn from that? And so for us, and then Paresh, after this, we can take some questions and then we'll go into the case study section of this. What exactly were the patterns, the historical patterns here, and how can we try to exploit them in the present? This is about application. This has been my journey since August of 2006 and 2007. So Paresh, let me take a moment and see if there are any questions, and then we'll go into the case study part after this.
Yeah, thank you, Yen. Very interesting, very insightful. Looking forward to the rest. Couple of questions, Yen. You mentioned that earnings multiple doesn't matter in a manner if you're thinking long term. And when you mean long term, what do you define as long term? What's your typical holding period?
So it matters, excuse me, in the first probably 3 years. 1 year definitely matters. By 5 year, you're starting to burn down the multiple over that 5 year period. I think by the time you hit 5 year, unless it's excessive valuation, you're pretty much already there. Our holding period, so more than half our portfolio, our firm is only 6.5, almost 7 years old at this point. And over half the portfolio is between 4 and 7 years old. So we don't know what the actual holding period is. We target north of 5 years. Our turnover is actually quite low. We're looking for these outlier right tail, very durable, long pattern growth. And this again is a game selection question. We'll get into further on this as well. I think game selection is the most important decision we make as investors and leaders, is what is the game we actually play. And we're looking for 5 to 10 year, very brisk and durable compounders that can generate north of 20 to 25 or even 30% returns over that time period. There are very few. And so in fact, the data set I shared with you before, on a 10-year basis, only 3% of securities can do this. Everything else mean reverts. But yes, we're 5 to 10 year investors, if not longer, we hope. It really depends on, can companies sustain that growth algorithm for that long or longer? There are very few companies that can. But I think that's a very powerful and important insight, Paresh, that if you find, and they're very rare, and by the way, run the exponential math of what a 30% 10-year compounded does on your capital. And it's the second 5 years that are even more important than the first 5. And when you find them, you need to know how to ride them. And that's a very important skill.
Yeah, that's the judgment to extend your investment horizon beyond the first 5 years, when the probability of success for the next 5 years is going to dip considerably. How many positions do you have in your portfolio? So because as you said, there are only 90 stocks in your 20 years of research or 25 years of research, which could compound 20% plus over decades. So, which leaves you with a very small sample to pick from.
That's just a North American sample. So if you times it by rest of world, you probably can double it. And that's above $2 billion in market cap. So if you're a smaller cap, you actually have a larger universe, but there's also a larger failure rate. So we run a 20 stock portfolio, of which our top 10 sits at about 80% of our equity. So the top 10 become very big, because you want to let your winners run. The right tail, you need to let them run. That's another very important and hard skill. But you're correct. And I think what we're shooting for is, we're fine if they're 5 year, 20% compounders, and that's 14% of the cohort. So that's plenty wide, actually. Yes. But you're right. For them to sustain for 10 years, you're dealing with a very, very, very small addressable market. And I think it's important also, investing is a game of real options. You learn as they are growing, as they are expanding. You're learning about them and you. And when you find something that truly can compound at 30% for a decade, you're dealing with something extraordinarily special. And the irony is that, I think that's about 13, almost 14 times your capital in that decade. And if you think a 50% overpriced stock is some reason that you should sell something that you can over 10 times your capital, that is one of the things that you have to consider very carefully. The ride phase is very difficult.
Interesting. There's another question. This question is, can you expand on the thin line between struggling and suffering?
Absolutely. I think this actually came back to Viktor Frankl and the man's search for meaning. And, pain, I've studied pain a lot. And let me give you one just very simple tool to think about this. People think that Warren Buffett's got extraordinary pain tolerance. For those that are parents in the room, we all have his pain tolerance. It's just a question of what do you want to take the pain for? So here's the analog for you. If there was a burning building and I said to you, Paresh, for $1,000, will you run into that building? You'll tell me no chance, Yen, right? There may even be some people in this room who would do it for $1 million US, right? Maybe. I hope not, but maybe. But if there was a loved one in that building, we would all run in there, right? We wouldn't hesitate. That's meaning. And so what I mean for you is like, if all this is just a profession to make a basic living, which I'm not above, to be clear, like life is hard. Let's be clear, right? But what I was trying to rewire you to is if you're seeking greatness, self-definition, self-actualization, deepening the understanding of this art, trying to get resonance to it, serving a higher purpose, a higher goal, whether that capital serves something that does, serves society in a bigger way, does something and grows something, creates something, you just can take a lot more pain because you expect it and you can persevere through it. And I'll tell you, most of us should never be entrepreneurs. I believe most people should not be. They can't take the pain of the ride. It's an extraordinarily pain-driven experience. And the reason why it's so lucrative is because you have to keep powering through each one of those. And if you don't have a high, I call it a why. If you have a big why, you always have a good how, right? If not a great how, you find solutions. And so that is my most important meaning for you. Another small analog for you, if you're physically training and all you're doing is like, I just want to get a sweat, right? Oh, you know what? I feel a little bit off today. I'm not going to go to the gym. If you want to go train to something and, for a race or some like where you've raised a lot of money for a charity or you're training with your friends, now you have a bigger why. You don't make excuses. That's my point.
And excellent, all very, very, very insightful. Yeah, and there's another question, and I'm just kind of blending it, a couple of questions in different words. But the question is that, you kind of talked about patterns on the right tail over there. And, you kind of talked about in earlier slides, 3 kind of, investment strategies or frameworks which help you identify winners. You talked about the horses. You also talked about, case studies which you have kind of, researched on the left tail, and you have a shorting book. So, are there any patterns, on the left tail which you kind of would like to share where, people who have only a long book can avoid those kind of businesses or patterns, and people who are interested on the short side could learn from that?
Absolutely. And I know this is a value investor conference, and I've always been asked, is like, how on earth is short selling fit within a value investing framework? The first thing I'll tell you on that, I'll answer your question directly in a second, Paresh. Short selling is alpha mining. People mistake this all the time. Alpha is incredibly important. It's very, very hard to do sustainably. And alpha transporting is a very different question. Like if you can create alpha, the second question is what do you port it to? We short, one of our purposes of shorting is to protect our long book. Second is to create alpha. Third is to, create P&L. And it's like we actually can use alpha in many, many different ways. But let's get to, one of the left tail patterns, and it's a beautiful one. And it actually helps you as value investors. We call them structural shorts. The definition of a structural short is the premise upon which the industry was built is no longer true. So these are formerly good and great businesses. And if they were built today, they would not be built that way. And that's because technology and or business innovation has changed it. There's tremendous businesses that were amazing this past decade, 2, 3, 4 decades, that have now been profoundly impacted. Retail is a classic example of that, right? You would not build a retailer today the way that it was built over the past 30 years, given e-commerce. Cloud is another incredibly disruptive business model. You would not build a software business the way you built it 10, 20 years ago, a database business 10, 20 years ago, which are great businesses, but you would never build them with the cloud architecture you have today. SaaS is a profoundly superior business model. So these are what we call them structural shorts. These are where the upcomers actually have a strategic advantage over the incumbent. And over time, the moat is cracking almost every single day. We love structural shorts. The analog to digital transition, almost all of them are deflationary. It makes it incredibly difficult. Shrinking a business is very, very, very tough, right? When you're running against a shrinking top line, you're literally every day you have to take actions that are sub-optimized. You're not thinking long-term, and to make the leap from your existing business model to what's required to hold them off is very challenging.
Thank you, Yen. This was, again, very insightful. There are a few more questions, Yen, but maybe, in the essence of time, and I know you have, more interesting slides and the case study to talk about. So maybe, we will have the rest of the questions at the end of the session.
Wonderful. Let's do that. If we could just transition back to the slides, that would be wonderful. Thank you very much. Thank you for those questions, Paresh. All right, let's keep moving, and I'm going to introduce you to a case study in a second. So, can you learn the same stuff that I'm telling you about right now from books? We always talk about reading a lot. I think that's, by the way, very, very important skill, and all of us should learn how to read thoroughly and do it faster. I do recommend a course, and you can just go online, called IRIS Reading, IRIS. There's tons of speed reading and effective reading courses in there. It's not the best, it's good enough. So reading is analogous, but it's slower. Case studies are hyper-specific versions of content creation. Warren Buffett here, he created tremendous pattern recognition from reading annual reports. This is just using it in a different way. Case study methodology, we're using history to be your guide. We're using radically increased repetitions to try to develop your pattern recognition, to help you see opportunity, and then endure bumps. The difference between what you think and what you know are profound, right? It's everything under stress. So the case study methodology. Let's let history be your guide here, all right? So the first part of this is picking the right genre to study. There are lots and lots and lots of different genres. You want to cluster this around one genre and then deepen. Pattern recognition is having the data sets to tease out value creation and value capture, understanding the mathematical sources of it, understanding the qualitative factors of it, and then the stock price. Second is you could do it also for judgment, trying to create a flight simulator for decision sets. I'm going to walk you through one that's more on the first on the pattern recognition, then on the judgment, but you can structure them where you have the data at the time, and then you can see what unfolded over time. And the whole point of this is to accelerate your experience curve. So let's start with the right genre. This is a study from a guy called Professor Henrik Bessembinder, Arizona State University, 2017. What Professor Bessembinder found, and we recreated the entire data set to validate it ourselves and adjusted it for market caps that were more significant for our sectors and the way that we invest. He said over a 90-year period, 100% of equity market value creation, or $32 trillion at the time, came from 4% of companies. The extreme right tail is everything. 983 stocks created all of this. And in fact, the top 1%, less than 300 securities over a 90-year period, contributed $24 trillion, or 3/4 of it. It was tremendously concentrated. We've already been studying the right tail, but his study brought it home that it's even more important than even we realized. The bumps. I'm going to get into the case study in 1 second, but I just want to prepare you for the bumps, and let's get into it. You have to know how to endure the ride, right? So we've studied hundreds of 20% compounders over rolling decades, and every single one of them pretty much experiences at least one down 50 during each decade. You can't predict when they occur, but we are not at all surprised when they do. We experienced 4 of these in the past 2 years. So the question is, what are you going to do about it? And will you be prepared physically, mentally, and emotionally to respond? Are you conditioned? So first lesson for you, and this is from someone I know that you're all familiar with, Manish Prabhurai, who wrote the Dundo Investor, wonderful book on this. This is risk versus uncertainty. You have to know the difference, right? What is risk? Risk is a function of price. It always is a function of price. Uncertainty is an inherent part of investing. We are in the future business. It's unknowable. You want to reduce variables, but it's unknowable. They overlap, but they are profoundly different concepts. And this is what's important in terms of loss management and understanding the difference between marking risk and permanent capital loss. Risk, in our view, is always a function of permanent capital loss where you'll never recover it. And the x-axis here is time, the y-axis here is price, the squiggly line is the volatility of price action in a single security. We train for that circular red moment where price dislocates, and we have to determine, is this a mark or is it permanent? Do we add down, do we hold through, or do we cut? This is the exact moment. I call this the bottom of the Nike swoosh. This is the moment that financial analysts are trained for. This is the reason we get compensated for the stresses that we endure. Permanent capital loss, to put this in context, is the equivalent of if the Federal Drug Administration was going through a drug evaluation for a biotech stock or just any pharmaceutical approval process, and it went and the trial went negative. The stock collapses. It's never coming back. Why? Because fundamentally it's broken. That's permanent capital loss. A mark could be Berkshire Hathaway, draw down with the markets in March, down X%. Has anything changed in any of their businesses? No, the moats are still holding. Yes, there's economic differences than what it was before. That is called a mark. So quickly, I'm just going to walk you through just the bumps and what you should expect. This is S&P 500 returns for 60 years as of 2017. The blue line here is S&P return. The orange line is the EPS growth. It seems really choppy and highly volatile. Well, this is what it looks like when you smooth out the curve for 60 years. The curve is actually relatively benign. Now, the extreme left tail is pretty ugly. The only reason I bring this up is you need to start training your mind to be prepared for these things. These are all the 15% plus drawdowns over the past 60 years, again, up till 2017 is when I did the study. There was 21 north of 15% drawdowns over a 60-year period, 11 over 20. And they were really clustered around a couple of points over 2 to 4 years where there was tons of them and lots and lots and lots of 10% moves. You have to know what type of volatility you're taking, what to expect, and how to deal with it before it occurs. This is the depth of the drawdowns. Again, some of these can be extremely long. And so the question is, how are you going to endure these? Because these are natural. You know what's going to happen over the next 60 years? There's going to be wars. There's going to be shocks. There's going to be pandemics. There's going to be manias. There's going to be crashes. Like, all of these things are true. Why? Because they've already happened in the past 60 years. And so it's not unexpected. It's what are you going to do about it? And so let's get into a case, and I'll show you how we train. So elements of a great case, let me set this up and let's bring it alive. The first is just understanding an industry structure and then the company strategy. The second is having enough data to assess it. The third is having detail if you want to design it to make decisions and feedback loops after the fact. The fourth is contrasting to other companies in the industry to understand the differences in the counterfactuals. I call that type 2 learning. Type 1 is temporal against itself over time. The second is type 2 against other companies so that you can contrast and compare. Very, very important part of my process. Number 5 here is structure the debrief. This is even more important than the case. I'm going to get to this also when we talk about O'Reilly. Who you debrief with it and how many cases you debrief at the same time is what lets you bring all these insights alive. And we do it with trying to bring the management teams of the companies themselves to the debrief and or experienced investors and analysts. It helps bring this alive tremendously. It takes it out of the academic realm. And then finally, you want real life applications of this. Nothing teaches you more than putting it on the line. All right, so let's go into the case now. Okay. All right. Sorry. Yep. Okay. So this is O'Reilly Auto Parts. I'm going to spend about 10, maximum 15 minutes on this. Cases are usually debriefed in about 30 minutes, which we now pre-tape before a debrief. We don't even do it live anymore. The debriefs usually take between 60 and 90 minutes, where we're really trying to flesh this apart. This is from a case study that was done in the Columbia Business School class of 2013. It was one of over a dozen cases we did with students over the course of 2 semesters. we debriefed actually when we did this 6 cases across multiple industries with the exact same investment genre. This is compounders or our horses examining the earliest stage we could get onto them. So exiting, there are 3 natural stages of the life cycle of a business: proof of concept, replication, maturation. We only, as investors in horses, focus on the replication phase. We were trying to work out, is it knowable between proof of concept, transitioning into replication? What were the risk factors to de-risk an asset as early as we could get it to capture a tremendous amount of that compounding? And that's what we were examining here. Now, this case was done with the assistance of 1 TA per student. I'll be preparing, just so you know, a separate video, which I will put onto my YouTube channel, that will walk through this in a little bit more depth. It'll be about 10 or 15 minutes long, but just so that you know, we can watch that separately. This one is long and detailed. It's about 59 pages. On average, we do about 40 to 60 pages. This took 100 to 120 hours of the student. It takes about 80 to 90 when you do the second one. So there's no shortcut on these. These take a lot of work. Let me dive into this. So O'Reilly was one of the most successful compounders over the past 3 decades. This we examined from 1993 through to 2013. And in that time frame, it compounded at 21% or 40 times your capital. Extraordinary business. We call this a cluster horse. A cluster because 4 of them did it. The whole industry structure was amazing. So this was Autozone, O'Reilly, Advanced Auto Parts, and Napa. All 4 of them were very successful investments. So O'Reilly is an aftermarket auto supplier in North America. Let me walk you through the deck. I'm not going to do this in excruciating detail, but I just want to give you some highlights to get a broad sense of it. So first of all, we're just setting it out into the various stages of its evolution. Try to break down the chronology of the evolution of the business as best we can. O'Reilly started in a part of Missouri, one of the smaller states of North America, and expanded nationally. It actually went from a very, very local business to a pan-regional to a national business, and we were trying to examine all the various stages of this. So how do we set it out? First of all, we're just trying to do a quick overview to get a sense of what's the company about, give you a quick summary of it. This is where all the geographies they were at various stages they acquired and advanced. So you can see here from the A, B, C, D, E, they moved around over time, and just the chronology of how they expanded it and where their locations was. Very important part of this is an industry map. If you're always going to start orienting yourself, I think it's really important to understand how it fits into the whole industry structure. This is something we do for everything. And then now starting to understand the concentration or how fragmented in this situation this entire market was. This was mom and pops to start with before the consolidators started taking control of it. And these were the 4 consolidators: O'Reilly, AutoZone, Advanced Auto Parts, and GPC or Napa. And they had, there's 2 business models within this, just so that we're clear. DIY stands do it yourself. This is auto market, where you get the parts and you fix your own car. Do it for me, where it services garages, where the garage fixes your car. All of these serviced both. And this is part of the approach here. The quick anatomy here is they IPO'd in 1993. We actually examined the period prior to their IPO in getting all of as much data as we could before it, and then examining this 40x ride as best we could. And the most important part of this case study was examining the transition from a local business to a national business, or at least a pan-regional business, and what were the de-risking factors. That's what we were trying to understand. So the main question, and the question is always the most important part of any case, what are you trying to solve for? And what we were trying to answer was, could we put a mosaic together where we would have had conviction to size up when it was transitioning from a local business to a national business and understand the moat? So, walking through some of this is just trying to understand the amount of alpha it was created versus market creation, and then start framing what was the de-risking factors in here. All right, let's get into the phases now. So this is when it was still a small company, private, small town focus. What was happening even pre-IPO? Quickly looking through its history, building up the number of stores, where were they? Hyper local business within Missouri. Why was it even created? This is again servicing mom and pops. This is a lot of very SKU intensive, SKU intensive business. What was the insight here that they had, and then what did they try to do? This is in replacement parts only, and this is the management team. So the O'Reilly family, when they actually listed this stock as of 96, they controlled almost 40% of the company. Incredible culture in this organization. By the way, for anything that you're holding for 5 to 10 years, culture is everything. And so it's deeply understanding what this family saw and the way that they managed their asset was a really important part of our process. It always is, candidly. So now we're going into the stage where they're now listed, they're regional, they're local going into regional. And what we're trying to understand now is the stage that they're going through. Can they execute it? It's not only good enough that it's a great business model in a big market, can they execute it? And so what we're examining now is, as you can see from here, in this period from 93 through 97, O'Reilly stock went up about 170%, but it wasn't that materially different from the S&P 500. A lot of this was also market tailwind. They were executing nicely. So we looked through. This is important in contextualizing for you now. I'm sorry this didn't translate so well, but making sure that you've got all the financial data to be able to make those decisions. And again, try to understand now, what were the actions? They started getting bigger. So you'll see from this, it started getting lumpier in the number of stores that they were expanding through M&A and greenfield. So part of this is examining what is important about the company. What's the strategic insight of the company? What makes it differentiated from its competitors? And in this one, I won't go into too much detail. One of the key insights of O'Reilly was your SKU availability and how fast you could get it to market. So garages are very time sensitive. People are putting their cars in there. They want them serviced and returned back to the client as quickly as possible. So you need the part and you need it quickly. And what we were trying to work out from this is exactly how did they do it. But that was the advantage. If you can solve for a good price, high service level, SKU availability, that was a material differentiator and the key element of their strategy. So I'll move faster now. Understanding the moat. This is Act 1. Act 1 was local. Understanding how they were out competing their competitors on a local and pseudo-regional basis. And this is now what they started doing is expanding regionally and understanding what was going on there, store level unit economics. Now they're starting to expand materially and again, putting yourself in a position now of looking forward, what could you have underwritten from a revenue growth, margin, and then valuation perspective, just having enough data sets to be able to bring that alive. And this is actually one of the decision points where if you're 1995, valuation, what would you have had to assume to return? This is inverting. At the stock price at the time, what were the different assumptions that one would need to make to generate very substantial returns, and were they real? So now you're putting yourself in a position where you have all the historical data. Now you're starting to go take a snap in 95, move yourself forward to 2002, 7 years forward. And could we have assessed that or not? And then start getting the data sets to see what actually happened. This is understanding the quality of the business versus other retailers. And now we're starting to get into, and so this again is just unit economics. I won't go into too much detail on this. This is where they started going national. So they started moving now into both M&A and greenfield. And it was a very, very important part of their business model. It was experimenting at a local level and then taking it national. So what they ended up doing is both greenfielding and buying out companies. And if they wouldn't sell, they would actually go into those markets and try to penetrate them. And then others would sell to them as they saw how hard it was. Understanding the bear case is an important part of this. Also, this is available primarily through sell-side research or pulling up from press reports, making sure that you understand that sentiment from other investors and trying to get some sense of what it felt like during that ride. Why were there in this situation so many sell reports in 1994, as you'll see in the top left there. And now we go to the big step up, and then I'll conclude this. The really big part here was Act 1 was local, Act 2 was national. Could they do it? And this is the whole crux of the case. What things were we looking for to try to understand this? And so they, in O'Reilly's situation, they acquired a very, very substantial asset that gave them procurement scale as well as a geographic expansion. And then it came back down to this. We were looking for four things. on to de-risk this asset at this time, on unit economics, understanding the growth trajectory, anything else we could learn from analogs, and then what was the TAM. And this case gave us more and more data on this. So this was the second act on national distribution. Stock explodes. It goes up 14 times against the S&P that was up 50% over that 6-year period. They executed tremendously. And so when we're looking back in history, what drove this value creation? And is it something we can apply to today? I won't walk through the rest of this. It's again, just more of the same. And like, it's trying to study from what's available on it. This was where their capital allocation, we're looking through all of their Ks and Qs and their analyst presentations. And it was the same strategy for the entire time. And then the takeaways in the debrief is where it gets important. And what effectively we're trying to do here. And this is only one case. And I think this is the last and most important takeaway from this is one of 6 cases that we did in that particular debrief, one of 12 that we did over that year. And there was 2 stories in here, one of local scaling, and then the second from super regional and national scaling. But there was 2 things that we were trying to work out and tease through all 6 or 12 cases. One is the drivers of value, and the second is then understanding the risk and the trade-offs that we would have had to make as decisions during the life of that investment as an investor. And those 2 are separate objectives. So with that, let me pause the case and let me finish up on some other slides, and then let's go back to Q&A. How are we doing on time, Paresh?
I think we could, continue for another 15, 20 minutes or whatever, maybe 20 odd minutes. Should that be fine?
Perfect. All right. I'll just conclude with a couple more slides, and then let's go back to Q&A.
Yeah.
Okay. So another major adjustment was the long-short equity world. And the reason why is, again, I just want to bring Gandalf to the fray. When we started our long-short business, our first few years were actually the worst performance I'd had in 20 years. Why? Interest rates changed. The only reason I bring this up is and this was the whole industry we discovered. We ended up finding out that, so this is what happened to the long short world over this past 30 years. The light blue line is MSCI world returns trailing 12 months since 1990 through 2019. The dark blue line is HFRI, which is a hedge fund index, pre-GFC, so before 2008. The dark green is a bond index, and light green is what the hedge fund industry did after GFC. We were so frustrated. And the question, and the reason I'm bringing this up for all of you is you have to think for yourself and you have to work out why. The whole industry went cold for a decade. Why? What we worked out was actually this is all interest rates, but we have to do something about this. And by the way, it's a structure. Long short is a less than 100% net exposure to the market. It's a defensive structure. And in this past decade, S&P returns was 17%, incredibly cyclically strong. I don't believe anything changed in market structure. So we worked out, actually, it was everything to do with shorts. I won't go into depth in this today, but there was one fundamental part of the business model that profoundly shifted. So Gandalf returned again to us. And Gandalf taught us, wow, there's some big problems here. What are you going to learn and what are you going to do about it? So the part for me was we examined the structure of the industry. It had changed. We had to change it. We would have, vanquished with the industry. We adjusted. And this is the other part of it that is really important. This is one of the first things I said to you. Strategy needs to meet the skill of you. Just because a strategy is proven doesn't mean you can execute it at a world-class level. This is Michael Jordan, one of the best basketball players in the history of the game. Extraordinary athlete. And by the way, a very good baseball player. He just couldn't make it to the elite level. This is one of the best conditioned minds and bodies in the history of athletics. The point is, not all of us are built to execute every strategy. You have to find what works for you. If you've taken any golf or tennis lessons, this is what should bring it home for you. There aren't many of us who are going to be Roger Federers or Tiger Woods, no matter how many lessons you take. And so this is one of the final things for you. It's this book changed my life. I think it's one of the 5 most important investment books of all time. My firm is named after Genghis Khan's army. Aravt is number 10 in his decimalized army. This one decision changed everything in 2016 for me. We shifted from variant perception to unfair fights. Every single one of our businesses is advantaged massively. And our job is to find great risk reward skew. It changed everything in our process. It simplified it and it created far superior outcomes. To close the loop on strategy must meet skill, and skill is defined by temperament and skill. We launched with 3 strategies we know are right tail. Upon review in 2016, we said, how good are we at those? And of the 3, one of them, we didn't prove ourselves, even though we know exactly what to do. 2 of the 3, we were definitively world-class, but we decided, you know what, there's only one that matters. And the risk system is the one that we know how to build the most effectively. So we even stopped doing the second one. So we just focused on the horses. But the point is, you have to find more than half the game is who you are. And so last part I want to leave you with is structural advantage. There are 3 S's in the essence of a powerful firm to be really contributing. And it's strategy. Is there alpha to be mined consistently? Is it skill that matches that strategy and temperament? And third, are you structurally designed to take advantage of it? So many of you are very committed Warren Buffett students. I actually think the businessman is far superior to the investor. I think his outlier genius is how he structured his business. It's a massive unfair fight against the rest of the world. It's structurally advantaged beyond almost any other fund structure I've seen. He has compounded capital at 20% for 60 years. It's impressive, but actually he did it with 60% structural leverage. The 20 is good, right? But it's because he had the structural balance sheet advantage. The 3 parts that I think are extraordinary, he did it for 60 years, right? That's absolutely extraordinary. The vast majority of his wealth has been created since he was 65, over 80 billion of it. Drawdowns, he suffered 2 to 3, 50% drawdowns. Virtually no fund alive today in a conventional structure can withstand that level of pain. And he did it with paying almost no taxes. It's the last 3 that are truly extraordinary. There are 4 elements that will define how wealthy you are in 40 years. The amount of capital and how deeply deployed it is, the rate of return, the duration, and the tax effectiveness. You have to get all 4 right. And that's the genius of Warren Buffett, is he got all 4 perfectly right. So quickly closing, Charlie Munger, this is just lessons on volatility and structure. His partner Munger delivered 20% for 14 years with an average vol of 33. He suffered 2 down 30s in the last 3 years of his partnership. Absolutely devastating. I'm not sure if many of you know, but Berkshire Hathaway was actually 3 people up till 1974. Rick Guerin was their partner in crime who ran Pacific Partners. He compounded capital at 33% for 19 years. He compounded his wealth at 220 times. But again, he suffered such a major drawdown in 74, 75. He actually had to sell his Berkshire stock to Warren. It knocked him out. But many firms, again, can't stand this. And then one last one, Prem Watsa, who we also all admire. If he wasn't structured, he's compounded at 18%. If he wasn't structured with Fairfax being a listed entity, he wouldn't be around today. He was down 80% for 4 years and down 50 again. Not many funds would survive this. Last thing I'll leave you with is, there's been a tremendous amount of information shared with you today. I believe that this world is absolutely addicted to information. When it needs to assimilate it, it matters far more what you take from this and then you apply. It's not about how much you read or you learn. It's how much you absorb and apply. So this is, if you're a Star Trek fan, this is the Borg. Like, be the Borg. Absorb and assimilate and apply. And so in closing, decode, simplify, and execute and refine. Take the genre that you want, decode it, simplify it so that you can execute it, and then constantly refine. And so my final wish for you, choose a game that you find deeply fulfilling. Don't just do this for success. Learn to lead yourself and then others. Train yourself. Be sovereign, total sovereignty on your outcomes. Surround yourself with peers that you admire and respect and hopefully can learn with you. And then acquire some mentors that can drive that path forward even faster. Train and learn with rigor and purpose. That will define your life. And then finally, work extremely hard and then win like crazy. I hope you embrace and enjoy the struggle and this journey of excellence. And then finally, please stay in contact. That's not my personal email, but it's a way to get in touch with me. And then follow, I will be posting irregularly some of my lessons. COVID has taught me to share with the world a lot more knowledge as what I've been teaching at various universities. Everything will be posted onto YouTube. That's video, Twitter irregularly, and LinkedIn. Thank you so much for your time. And Paresh, let's go to some final questions. Thank you, guys.
Thank you, Yen. This was, really, really generous of you to share on your learnings, your insights, to share your case study, to share, the structure, the framework of your case studies. Very generous. Thank you, Yen. Thanks a lot.
My pleasure. Paresh, do we have time for any final questions, or are we concluding?
No, we can. I think, we started about 15, 20 minutes late. So, I think we had 90 minutes. So we have still another 15 odd minutes left. We can do a few questions.
Great.
Yeah. You spoke so much about, the details of your case study, so much amount of work and, hours go in, of the team and, before each of the case studies. And, so the one question which comes, and there are two parts to this question over there, that, after doing so much of work, you identify, I'm just kind of using your own case study example, you identify a cluster, or you think, this is a winning cluster, or so on and so forth, or, you kind of, you think this is a horse. And, and how do you kind of check yourself from your commitment bias of doing so many hours of work, engaging with so many experts, speaking to the management teams, engaging your entire team who's excited about, the work which has gone into it. How do you check your commitment bias towards the work? This is still not your investment, part one. And, maybe I'll also, add the part two. Now, maybe, you've already done your investment and, by definition, you're very excited about it. You think this should last a decade, the phase one of the 5-year journey of 20% plus. And, most likely, by definition, if we like the investment and we let it kind of be part of the portfolio, we think, it's a likely candidate for phase two. In this journey, after you invested, either during phase one and phase two, how do you check? And then there is the bumps that you talked about, each of the businesses can go through bumps. And some of the bumps may be company specific bump and not a market specific bump. And whenever there is a company specific bump, there is a narrative. The narrative talks about why there is a sell-off in that position. So how do you basically, check for the commitment bias at that stage during the bump?
Amazing questions. There's three different answers to the questions that you laid out. The first is to avoid the commitment bias, and we literally spend hundreds, if not thousands of hours on our positions. So you're 100% correct. And before a position even gets into our portfolio, we put it through a pretty rigorous team process. We have forensic accountants, we have investigative journalists, but one of our most important processes is we sit down as a team before anything even comes close to getting into our portfolio for multiple hours on end. And we actually sit down in our team where all the documents are presented about a week in advance. And the team sends questions back to the lead analyst. And we spend a few hours debating nothing but disconfirming or tension points, anything the team disagrees with. We don't spend any time on things we agree with. There's no point. And so that meeting alone is exclusively focused on where could we be wrong. We just went through a process recently where I was extremely bullish an idea and my team was very negative, and they came up with several things that I hadn't thought about. And by the way, that's part of the power of having a team. I actually think it's wonderful that they are independent thinkers that bring in disparate views all the time. That adds tremendous value to me. We've never gone through one situation where at least one, if not three, major insights come from that underwriting process. So that's step one in avoiding confirmation bias, is actually having a disparate team of people that you respect, giving them the information to come debate, focusing the debate exclusively on the disconfirming or tension points, and then having that conversation well before you actually commit capital. Because I 100% agree with you, there's various stages that you create commitment bias. The second one is once you're committed capital, and by the way, our batting average is over 70%, right? For this type of genre, our batting average is world class, but we're still wrong 30+% of the time. And so part of this is building inherent risk systems already that will address that you're just going to be wrong. So there's certain things already from a capital perspective on that will stop us adding good capital after bad. But what we also do is we highlight disconfirming evidence. Our theses, we know they make money. We don't need to prove that, right? We just know it because it's like they're mathematical tautologies of what we underwrote, and we focus on the KPIs that drive it. So we have two separate processes. Every single quarterly call, if there's anything, we write our reviews on every quarter as a thesis. It's already, here's the thesis, is the evidence confirming or disconfirming? And we highlight the disconfirming every time because you don't need to highlight the confirming. The second is KPIs within that thesis. Are the KPIs trending towards your thesis or are they broken? And in advance, you want to know the engineering tolerance of those KPIs. If this strays out of this zone for more than 2 quarters, we need to have a conversation. Look, life is not neat, right? But you need to set certain things out in advance that let you see it. Otherwise, it creeps. So we do this in advance, and twice a year, we do a KPI review. We call it a pre-mortem review. If it's outside of those KPIs, we need to talk about them. We need to highlight them. And then finally, on the bumps, this is a great one. And this is where you actually have to be fully prepared. And you already touched on it. We call type 1 volatility. That's just market volatility. Market volatility, in generally speaking, for our positions is a gift, right? It's got nothing to do with our companies. It's just systemic selling. And that's phenomenal, actually. Blind, fearful systemic selling is a gift to us. We're very prepared for that. The second one you've described is what we call type 2 or 3. It's type 2 is a sector level or a factor rotation. Type 3 is a single stock. So you're talking either 2 or 3. Our approach on this, beyond a 20% drawdown, we put a second partner to re-underwrite the entire position. Clean set of eyes. Very difficult for the person who did it the first time to see the cracks. So we actually pull someone else off their coverage, put them on for 1 to 2 weeks, re-review every piece of data. And then we have to rewrite the thesis to see if we're missing anything, we're reweighting something. And, short attacks are fairly common for us. And so it's very, it's not unheard of at all for us to have very large positions down 20+% being attacked vigorously by someone on the other side. It's not, super, super common, but our protocol is we bring someone else onto it after certain price thresholds on alpha, not on market, to give us a fresh set of eyes. And again, it helps to have the KPIs and pre-mortems in advance. And a pre-mortem, to be clear, is something we do in the underwriting process before we even engage capital, where we will tell people, we will already work out how we lost money in the stock and before it occurs and try to break our own thesis.
Fantastic, very detailed, and thank you so much. Another question was kind of a generic question on one of your slides. In your slide you mentioned the long-term market returns for S&P is kind of 9.9, give or take 10%. You also mentioned in that slide that we kind of going through a cyclical upswing where in the last decade the return is 17.6%. I'm just kind of connecting this with something which I read recently. You probably may also read Jeremy Grantham's interview last week in Advisor's Perspective, where he said that he thinks this market is a bubble and it's a matter of weeks or months. I'm just kind of connecting the two, and you're saying that this is a cyclically strong market, and maybe let's take the duration away, whether it's weeks, months, or years. But implicit in your slide, you are also saying that if nothing has changed and this is a cyclically strong market, then are you implicitly saying that you expect lower returns over the next decade for equities?
Yes, I am. My base case is I think equities will be lucky to do 5 to 7%. I think the biggest bubble in the world is sovereign debt. And I believe interest rates are driving everything. And I'm not sure if we're in a bubble yet, but the enablers of bubble formation are starting to show themselves. I do see some froth, but there's been $50 billion of equities that have flowed out of markets year to date as of September. $250 billion has flowed into bonds. I don't know of many bubbles where money is coming out of the market, even though I totally agree retail is doing some silly things. SPACs are obviously another indicator of this, but it's very isolated where it is thus far. I firmly believe in the next decade that a lot of money needs to come out of bonds into equities to have any chance in hitting institutional 6 to 9% liabilities. Bonds, there's no yield out there, and that's forcing capital markets to readjust. I believe in a low interest rate environment, multiples will be higher. I think they're already elevated. It's about 20% above 5 and 10-year medians on the S&P right now. But with a 10-year treasury that sits between 50 and 77 basis points, I don't find that inappropriate. And so the 60-40 traditional structure of bonds and equities, or equities and bonds, I think that 40 is going to really struggle this decade when yields are this low. People are chasing yield every way they can get it. High yield spreads are incredibly low, and we're in a major economic crisis. That makes no sense. All right. So if you're talking about bubbles, equities is a relative concept. Actually, interest rates really matters. And I think actually that the lower interest rate regime that we're facing globally right now, and I do believe that we're in a market that is that governments have taken control of, and I think they're going to keep rates. The incentives are incredibly strong to keep developed market rates very, very low. And if they do so, it's going to force more capital into equity markets because there's no chance in hitting returns without it. And that, what Jeremy Grantham was also touching on, all bubbles start on the premise of sound things. And I do see some elements of silly valuation, but I don't see them at large. The mega cap tech stocks that are driving the S&P and the NASDAQ right now are not crazily priced. Some of them are, for sure, right? I mean, some of these SPACs that are coming out with no revenues and $3 billion valuations plus, if not 30 to 10 or 20 for some of these. I mean, some of these are clearly getting a little ahead of themselves and a bit crazy. But, the broader market at large, I don't think is anything even close to what we were in the internet bubble, at a broad swath. But I do think it's something that we need to be prepared for. I actually think the biggest challenge in the next decade is that we're dealing with a lower return, probably higher multiple, potentially higher volatility, and likely higher dispersion. That's phenomenal for active management, right? I think great stock pickers are going to have a field day with this market. But I do believe market-wide returns, and the data set there was 9.9% returns from 1990 through to 2019. It's 10.1 for the 60-year return, and it was 17.3% since GFC. I don't believe anything is structurally changed about the 60-year return profile of a market prospectively. That was my point, is I just think we've been cyclically strong coming out of a very traumatic crisis stimulated with tremendous fiscal policy. I think they're still going to do a tremendous amount of stimulus over the next couple of years. But I believe the number one, and it's the most concentrated risk environment of my career, policy drives every single asset class in the world. And policy right now is incentivized very strongly to lower rates across the curve. They're controlling the curve. And that will have asset price implications across the board. And the value investors at this summit, my only word to you is reversion to what mean? That is the question you'll have to answer. Otherwise, you may be sitting out this whole decade.
Thank you, Yen. Thank you for your thoughts. Yen, we have many questions, and I also have many questions. But maybe I will kind of, ask you a question or two, and then maybe if you want to give some closing remarks. What are your thoughts? You kind of talked about very nicely about how you expect the broader market, and I think comments applied largely to S&P. But how do you kind of see the implications of what your prognosis for the larger market imply for the emerging markets, and specifically for India, if you have any thoughts to share?
I don't have specific thoughts for India. Emerging markets, obviously, one of the more important parts is US dollar strength. And I think dollar weakness is, let me step back even further, because I think all of emerging markets has a link to what US dollar does. And the number one phenomenon this past decade plus now is the lack of inflation. And it's also the number one risk in global markets, because inflation will drive interest rate policy eventually, even though this Fed has made it very clear they're happy to tolerate above 2% for a sustained period of time until they get employment back. And the traditional pattern for the US to bring inflation back is to actually let the dollar go, which would be tremendously positive for emerging markets. So that would be one thing that I would just caveat structurally in stepping back and thinking about is I think incentives are for a weaker dollar. And if so, that is where we could inflate. And by the way, deflation is the number one. It's the witch's brew. You do not want deflation in an economy. And so policymakers understand that as well. It creates a tremendous downward loop, right? A deflationary bust is hellish for capitalists. And so they will pull every lever imaginable to inflate. And it's been a struggle globally for 2 decades to create inflation, even despite this monetary craziness. So I think that's positive for emerging markets at large. Cost of capital being low is very good for the emerging or all of the growth world. I think, the demographics, obviously, for India, I don't need to tell all you guys how positive that is. And that's a very big driver for multiple decades of growth. So I think cost of capital is coming down. You've got the demographic drivers that will drive top line for a long time. You have a select number of extraordinarily talented managers in India. I think I'm a stock picker. What I gave you from my prognosis of markets, frankly, has almost no bearing in the way that we invest. We are bottom up in the way that we do it, not top down. We're macro informed, but we almost never make a decision that way. And candidly, anytime that we have, they're wrong, right? It's too hard. That's not a market that it's not an approach that I use. But I think for those, my number one thing that I would say, Paresh, is you already know who the best businesses are in India. And you can pretty much guess how the ones that are going to be 5 to 10 times larger in 5, 10, or 15 years in India. Be prepared. If markets go volatile, as long as humans are involved and you can amplify that with more, these quantitative and passive structures that we're seeing in the developed world. I don't know what is happening in market makers in India, but as long as humans are involved in markets, they're going to do crazy things occasionally, and then you have to seize them. And that's my point on the way that we invest. And that's the point that I really wanted to drive home today, is for the prepared minds. And you don't need many, but if you have a wish list of 10 or 20 stocks, that's plenty actually, because you probably only need to buy 1, 2, or 3 in that crisis, but buy them really well when you do. And fear will be everywhere when it occurs. And that is your moment where in your lifetime, you don't even need 10 of these. Right? You don't even need it. And I'm not talking about betting half your fortune on any one of these. If you're lucky, if you go 10 of one of these, my goodness, in 10, 20, 30 years time, you'll have institutions named after you. But be prepared is my only advice. Is it's unknowable and I think people spend far too much time trying to think top down. It's almost impossible, and it's not actionable. But being prepared is actionable.
Thank you, Yen. Thank you so much. Thanks for your thoughts. There's still so many questions from the audience. I have so many questions for you, Yen. We will continue the conversation, and we hope the entire CFA society can continue the conversation with you either in a sequel, or hopefully we'll have you visit India soon. When things improve. And I just wish you the best. And with this, I'll hand it over back to Jitendra.
Thank you so much, Paresh.